So good morning, everyone. I'm Abby, and I have Sophia here with me. We're going to be presenting our no vault presentation from FAZ Forensics to you guys. So thank you again to everybody who has joined us so far. We're excited to talk to you all about how we can help you in regards to no fault lost earnings calculations. And let's get started here. All right, so meet our team. So obviously, as I said, I'm Abby. I'm an analyst here at FAZ. I've been here about 2.5, 3 years. I started in January of 22. So coming this January, I'll be here officially 3 years. And Sophia, did you want to introduce yourself?
Yes, hi everyone. I'm Sophia. I'm a senior analyst here. I started around January, but I feel like I've been here a while with just the comfort level I have at this firm. I know that we do a lot of work with no fault, so I think this webinar will be really helpful to everybody to kind of see a little bit more about our process.
And the rest of our team here, one of our partners, Charles Amodio, he oversees the insurance department here at FAZ. He's really involved in our no-fault claims, loss of use claims, BI claims. So we go to him for pretty much every report that goes out here in the insurance department goes through myself, Sophia, and then Charlie. And then we have Janine Leary. She's our administrative assistant. She prepares all of our reports and all of our schedules before we send them out to you guys. Our senior analyst, Ryan, who helps calculate the lost earnings claims. Analyst Christian Leva also helps calculate the lost earnings claims. And our newest analyst is Rebecca Fankano, who also assists in the lost earnings calculations. So our agenda for the day, we have a few things we want to go over in regards to the FAZ claim process from once we receive a new no-fault claim to the final report going out to the insurance company. And we have Sophia, who's going to be showing you guys a case study, just an example of the work that we do from start to finish. And then we'll have some open time for questions and how you can contact us if you're interested in the work that we do. So we're going to start here with what exactly is a no-fault claim. I'm sure you guys are all familiar with the typical no-fault policy or personal injury protection. It's designated to pay promptly regardless of who is at fault or whether there was any negligence for economic losses. Here at FAZ, once we get the claim first, we see obviously the insured or the claimant is involved in an automobile accident and they're unable to work for an extended period of time. Therefore, they're not generating any earnings, and so they are not receiving a regular paycheck. And since they are self-employed, the insurance company will calculate what they believe the lost earnings estimate will be during the time that they are out of work. So what do you do from this point? Obviously, somebody who is self-employed does not have the same earnings, the same tax information as somebody who is paid wages or receives a Form W-2 at the end of the year. Someone who is self-employed is responsible for reporting all of their own earnings, calculating all of their own tax payments, organizing all of their expense information and reporting it to the government. So it becomes a little bit more difficult to determine how much of a loss that they've actually incurred. So this is where FAZ steps in. How can FAZ help your company? So here at FAZ, we can assist in lost earnings calculations for the self-employed. What we do here is once we receive the claim from the insurance company, we analyze the information that we've received thus far and determine if more information is needed or if we're able to send out an estimate right away. I want to say probably 90% of the time we do require additional information. Typical information we want to see we'll go over here in a few minutes, but if that essential information isn't readily available, we do need to reach out to either the insured or the claimant, or most of the time they are attorney represented, so we will communicate with the attorneys and the insured and the claimant to obtain that required documentation needed to calculate their loss. We will verify the insured and the claimant's earnings, making sure that what they say they earn is legit, it's actually flowing into their bank account, or they've actually performed the work that they say that they're doing. And then sometimes we will have claims where the insured or the claimant is able to work on a part-time basis post-loss, or they hire somebody who can help them continue their business during the period of their absence. So we can update those lost earnings claims for the part-time work and the substitute services throughout the period of their loss until they are able to return full-time. So the general claim information that we typically first receive from the insurance company will receive either a insurance company cover letter or a claim referral form. This kind of outlines the basic claim information such as the claim number, the insured or the claimant's name, date of loss, the loss period if they're aware of how long they're going to be out for, or if they know they're going to be out for an extended period of time with no return to work date in sight quite yet. Sometimes we'll see the full policy limit, and then we'll also see an outline of the documents included with the cover letter or the referral form. Typically, we see the New York State forms NF2 and NF7. The NF2 includes information on the insured and the claimant, including their address, social security number, birthday, the location of the accident, the extent of their injuries, an estimate of the time that they've lost from work, where they've been treated medically, and their current job history in the past few years. The NF7 includes more information in regards to the insured or the claimant's actual job, including their job duties, the nature of the business, time lost from work, substitute service information if applicable, and sometimes we'll see the insured or the claimant's estimated loss, what they believe that they are entitled to from the insurance company. Then we will also receive oftentimes attorney representation letters. Like I said, most claims that we see typically are attorney represented. So we get a letter from the attorney stating that they are representing the insured or the claimant, and any communication should go through them first before speaking directly to the insured or the claimant. We'll also receive disability notes, signed documents by the claimant or the insured's physician, supporting the time lost from work. Typically, these disability notes are updated every month or so just to show that the insured or the claimant is continuously being treated and to support their entitlement of the lost earnings. The biggest piece of financial information that we typically see would be prior year tax returns. We prefer to see the most recent 2 years. However, sometimes we don't receive them at all, which is when we would get involved and contact the attorney or the insured and the claimant directly. And then we'll receive other financial documents, which I will get into in a few minutes here as well. And here's just an outline of the New York State forms NF2 and the NF7. We do prefer to see these as it highlights the pretty important information for all of these claims, and we use these forms as a basis to proceed with requesting further information from the claimant or the insured. So I'm sure you all are familiar with these as you do work for insurance companies, but just in case you're unfamiliar with them, this is what they look like. The NF2 is typically 3 pages long, and the NF7 is usually 2 pages long. Okay, so now to kind of go over the FAZ claim process. So obviously, first we receive a new claim. And like I said before, if we don't have all of the information needed, we will send a request for additional information, which we call our initial request, the request that goes out first after we receive everything and have analyzed what we have already. We'll send that initial request out, typically within a couple days of receiving the new claim. Then if we don't hear from the insured or the claimant or their attorney within 30 days of sending that initial letter, we'll send a second request letter following up on the information that we requested initially. And then if we don't hear after another 30 days, we'll send a final request stating that, we've tried reaching out twice and haven't heard anything. And if the claimant or the insured wishes to continue their lost earnings claim, we do need that additional information. And then after 90 days from receiving the claim and sending out the initial request letter, if we haven't heard back from anybody, We will send out a closed file report, basically stating that we've tried reaching out a few times, we haven't heard anything back, so we are under the assumption that the claimant or the insured is not interested in pursuing their lost earnings claim, but if in the future they do come back with the requested information, we can always reopen the claim and pick up where we left off. And then sometimes we do need to send follow-up requests if we receive additional information after sending one of our request letters. However, that information is still incomplete or certain documents are missing, we'll send out a follow-up. And again, when we send these follow-ups, if after 30 days we don't hear anything, we'll send out another letter, and we'll continue to send these letters until either all of the information is obtained or until the 90 days has expired. And then obviously the next step would be to prepare our forensic report and analysis and send it over to the insurance company. So now to get into some of the financial documents that we typically take a look at when analyzing these claims. The first one I have on here is the Form 1040, or the individual income tax return. This is what we see probably 75% of the time. Most people who are self-employed will file what we call a Form Schedule C. This is included with the Form 1040, and it details the gross earnings, expenses, and the net income and loss from somebody who is self-employed. And if we don't see one of these Form Schedule Cs, we're either going to do one of two things: assume that the insured or the claimant did not report their self-employment earnings on their prior year tax returns, or we'll see if they have a separate business, such as a corporation or a partnership, in which they would have a business tax return, such as a Form 1120 or an 1120S, or a Form 1065, one being corporate and one being partnership. And then we will also take a look at any Form 1099s. This is an IRS tax form used for self-employed taxpayers. Typically, somebody who receives a 1099 will then report those earnings further on their Form Schedule C, so they can report any expenses and their net income. Typically, companies like Uber, Instacart, Lyft, we see 1099s from most frequently, but we'll also see 1099s from construction companies, other self-contractual companies, something along those lines. But sometimes people who just simply work for themselves and aren't contracted by a third party, they will just report directly on a Form Schedule C. And then sometimes we'll also receive a Form W-2, which is the IRS tax form to report wages. Just to note, FAZ does not handle claims where the insured or the claimant receives wages. Typically, those are handled in-house with the insurance company, just because all of the information is typically outlined on the W-2 in regards to their earnings, any taxes or expenses they have. So it's a little bit easier to calculate, but we will receive those sometimes if the insured or the claimant has multiple jobs. And some other financial documents that aren't as common, but we do see often, are profit and loss statements. Usually these are generated by the insured or the claimant or their accountant if they do have one. This outlines their gross earnings and their expenses, again arriving at net income or loss. Sometimes we'll see bank statements, whether personal or business statements, showing the income being generated when it was deposited into the bank account, and how much was generated. Then, like I said before, Uber and Lyft is a pretty common claim that we see. So we'll see the Uber and Lyft tax summaries. These can come in either annual forms or monthly forms. Sometimes we'll also see Uber or Lyft weekly earning statements, which I'll show in a little bit here. We'll also see invoices or contracts, typically from somebody who's doing construction work, painters, hairdressers, somebody who is performing a service and invoices the work done to the customer. And then if we are doing a sub-service claim, we will take a look at payroll records from before the accident and compare those to the payroll records after the accident. So now I'm just going to show you some examples of the documents that we take a look at when calculating these claims. Right here, I have a profit and loss statement from a daycare. You can see where the claimant or the insured reports their revenue, followed up by their expenses to arrive at their net income. We want to take a look at this to see a couple things. One, how much gross earnings they're generating during the time period of the profit and loss statement. So we can either see an annual profit and loss statement, or here we have a monthly profit and loss statement for the month of August. So this shows right here that the insured or the claimant generated $12,200 during the month of August, followed by their expenses, which totaled $7,600, arriving at their net income of $4,600. So this is always a good one to see because we can see exactly how much earnings they generated, followed by the exact expenses, and it separates out the expenses to show each individual category of the things that they're purchasing for their business. Now I have an example of invoices. This one is for a painting company, like I'd mentioned before, typically for construction companies or painting. Somebody who's doing work along those lines will have invoices to show, they worked a few days on this project and they paid for this much materials like paint or paintbrushes, something along those lines. So this really outlines exactly what they did from start to finish of the project. Typically, we'll see the date that the invoice was sent out, but also the date that the work was done, which could be one day or it could be, a few weeks of work. So we like to see these as well. And another thing to point out is somebody who's in like a construction business, a lot of the times their invoices will be sent out, but the payment will be received later. So I like to follow up on these invoices with bank statements to support that the income reported on these invoices was actually received by the insured or the claimant. Next thing I have on here is receipts. I feel like these aren't as common anymore since everything is pretty digitalized these days, but I will see from time to time actual pictures of copies of receipts that were generated either on a cash register or just cash receipts that were written out by hand. The example I have shown here is for a hair salon. I feel like that's where I see the most receipts coming from, just because it is a pretty cut and dry service that's performed and billed directly on the spot. So you can see here, like on the left over here, we have the shampoo, the color, the perm, the manicure, everything totaled a little under $120, and this woman billed out on February 22nd. Then we can get into the middle receipt here. This one was obviously from a credit card machine. Again, it shows the date that we want to see and the total. And on the right over here, we have another cash receipt. I honestly can't really read the handwriting on here, which does happen sometimes, but I am able to see the date and the total income that was generated on that day. Now we have bank statements. Bank statements are a great piece of documentation we like to take a look at just because we can verify that this income was received in the exact date that it was received. We can take a look at any expenses if the bank statements are directly from a business. However, if it is a personal statement, that becomes a little bit more difficult. So we do have to have the insured or the claimant verify which deposits pertain directly to business earnings. And if there's deposits on there that aren't business earnings, then obviously we would have further questions and we'll have to follow up with one of those follow-up requests or even just an email or a phone call to the attorney's office just to explain why some of the deposits on there were made after the date of accident. But like I said, this is a great way to show that the income the insured or the claimant is reporting that they received was actually received. And we can also compare these amounts directly to the tax returns, invoices, etc. So these are a great one to take a look at no matter what type of business the insured or the claimant participates in. Now for the Uber, Lyft, Instacart statements, any of these rideshare apps, delivery service apps, they always have some sort of earning statements directly in the app to which we will see the insured or the claimant screenshot, print out, download it as a PDF, and send over to us. So these are the probably top 3 most common documents that I see in regards to these different earnings apps that I've seen out there. So the first one here is Uber. The Uber statements show the week that they worked, how much they earned in just rides, how much they earned in tips, any bonuses they received on the apps, because sometimes the apps will push out incentives to get people to work more. So they'll say, if you have a certain number of rides this week, we'll give you $50 or something along those lines. But it does get factored into each week, so we can really see how much they were making during very specific periods of time. I believe you can also split it up into daily earnings, but typically weekly is good enough. Daily, maybe if the lost period was during one of these weeks, but the weekly ones are pretty good to see because you can see the trend of what they were making in the months prior to the accident. Then we have a Lyft statement. Again, the weekly earnings. You can see how much they earned in rides, tips, bonuses, etc. And then on the right here, we have Instacart. Instacart's a little different as they're not called rides. They call their earnings batches for when they go out and shop. So we can see what they made each week as well. And Instacart also kind of splits it up into daily earnings too. So these are good ones to see. These are very common, as I think this is probably one of the most common self-employed jobs out there right now, just because it's so well known and needed across the country. So we see these a lot. Now moving on to document verification. So sometimes we receive tax returns that either don't seem like they were actually filed with the IRS, or one of the tax returns in, let's say, 2022 is drastically different than 2023. We want to verify that information directly with the IRS. So what we've been doing for the past few years is we have been sending out what we refer to as the Form 4506C, or the request for transcript of tax returns. We send this directly to the attorney or the insured and the claimant, and they sign that form. We use a third-party service to submit this form to the IRS, and in return, we retrieve the tax return transcripts, which a common misconception about these transcripts is that when we send this form out, we get the tax return in return, which isn't the case. The transcripts basically just outline what's on the face of the tax return, the earnings that were reported on the tax return, and the total amount of expenses. This doesn't break it out into categorized expenses, and sometimes we also can't see the exact where the earnings are coming from. It does sometimes tell us a little bit of the expense breakdown, but not as much as we'd like to see it broken out. So we want to use these transcripts to pretty much tie out the tax return and confirm that the information is legit. This is what was filed with the IRS, and it makes us just feel a little bit more confident in the estimates that we're sending out to the insurance company. And just over the past few months, we now have been trying out a new online transcript retrieval service. Again, with the same third party that we send the 4506Cs to. This online service allows us to immediately retrieve the tax return transcripts. It does involve a little bit more participation from the insured or the claimant, as they have to have an email that we can send them this request to. They fill out their personal information, they sign the document stating that they've given us permission to retrieve their tax return transcripts, and the transcripts will be sent to the platform that we use immediately. Versus when we use the 4506Cs, sometimes the transcripts can take a week or two to be sent over to us. And during like tax season, for example, that can take even longer. So we are trying to switch over to this new online service, but obviously it's got its kinks here and there. So we're playing around with it, but hopefully one day we'll be able to fully switch over to that, just because it's much faster and much more convenient for everybody involved. Now to go back to the other service we can provide, not just the lost earnings claim, but the substitute service claim. If you're not familiar with what a substitute is, the insured or the claimant would pay either an older employee who is taking on extra hours, or if they had to hire somebody completely new to take over the business duties in their absence, we would refer to them as a substitute. And the documentation we would look for here, we want the substitute's contact information, we want copies of canceled checks, PayPal, Venmo statements, something to show that the substitute is actually getting paid and that they're actually performing the work that they say they're performing. And then we also may want to take a look at the substitute's bank statements. Typically, if the substitute states that they're paid in cash, we still want to support those payments. And if we take a look at the bank statements, we can see that the amount that they say they're getting paid is actually being deposited into their bank account. So existing employee or historically incurred payroll expenses, we would want to compare the pre and the post-loss payroll reports for all employees. Obviously, if the payroll post-accident is significantly higher than prior to the accident, we know that somebody in the company or a new employee has taken on additional hours to make up for the insured or the claimant's absence, and the insured or the claimant is entitled to those payments that they're paying such an employee. However, one problem we do see with this is that a lot of the times the substitutes will claim they are paid in cash and there's no documentation to support this. In this case, we would leave it up to your discretion to pay the injured party those substitute service payments. I think a few times we've had the insured or the claimant obtain like an affidavit or a notarized substitute service form, and we have a discussion with the insurance company, kind of determining if they think it's a good idea to go through with payment, or if there just isn't enough documentation to support those substitute services, then they wouldn't get paid. But that's kind of up to you guys. So it does make it difficult, but it's definitely possible. Now to get into the actual lost net earnings methodology. So basically what we're trying to do here is we want to compute the average daily gross earnings based on historical income. The gross earnings, if you're unfamiliar, is the earnings generated without any expenses taken out, what they make before any taxes, any business expenses, any fees. That's what we want to take a look at first. We get this from either the tax returns, the bank statements, those Uber or Lyft statements, invoices, a variety of things. And we take everything that we look at into consideration and determine what we think is the best representation of these gross earnings. And then from there, we're going to determine the gross profit and the discontinued expenses. The insured or the claimant would have a gross profit if they were reporting cost of goods sold. Typically, that's something that I would see with a construction business. They factor in materials, labor, etc. So they would have a gross profit, but a lot of the times we don't see a gross profit. We would just take into consideration the discontinued expenses, which Sophia will get into a little bit later. And we will find these expenses reported on the tax return or the income statement or profit and loss statements, but the tax return is by far what we consider to be like the most crucial piece of information because that's what was filed with the IRS. Then we would multiply the lost gross earnings by the lost gross profits and take into consideration the discontinued expenses to arrive at our final lost earnings calculation. So there's one of two ways we can go about this. We can take the discontinued expenses and deduct those from the lost gross earnings amount. I believe this is probably what we do 99% of the time. We take a look at the average lost gross earnings, we convert that to a daily rate, and then we take out those discontinued expenses. Which, just a little background on the discontinued expenses. These are expenses reported by the insured or the claimant that they would not need to pay as a result of their absence from work. And I think the best example of this would be gas and fuel. Let's say an Uber driver has reported gas and fuel on their tax return. Obviously, if they're not working, they can't drive their car and they're not paying for that gas and fuel. So we would take that expense as a percentage of the total gross earnings and deduct that percentage out from the lost gross earnings, which Sophia will explain a little bit more in depth a little bit later. But this is probably a point of confusion for the claimant or the insured because they don't quite understand why we've arrived at the number we've arrived at, but it is important to take those into consideration. And another way we can calculate the lost net earnings is to take the net income and add back continued expenses, basically just the opposite of the calculation I'd mentioned prior. Continued expenses, obviously are the expenses reported by the insured or the claimant that continue to incur regardless of their absence from work. So something like rent or taxes, phone bills, something that they have to pay regardless if they're working or not. So it's just kind of a background on, from start to finish, how we arrive at our lost net earnings calculation. And now Sophia is going to have a little bit of a case study and show you guys an example of an analysis and a sample report that we would send out to you once we are completed with our calculations. So I'm going to turn it over to Sophia now.
Thank you so much, Abby, for all of that really useful information. Everything that Abby just discussed, I'm going to try and put into a real life case study and show you kind of exactly how we do the calculation that you receive. So if you want to go to the next slide. Typically when we start, and we also like to get this information from a claim referral form, and Abby can put that link in the chat for you for the claim referral form that has prompts for you to fill out all of this information. So in this situation that I'm going to go through, we're going to say that the insured owns a cleaning company that they operate out of their van. Very frequently, we'll see situations where people are running their business out of a vehicle and their vehicle will get hit. And that is when they come to us and say that they are claiming lost earnings because they cannot operate without that vehicle. This car accident as well will result in them being temporarily disabled. As Abby mentioned, we collect disability notes for things like this, and that's how we like to confirm that. Due to this, they are only able to work at a part-time capacity. People at times will be able to work part-time as a result of their disability. Some people are fully disabled. These are things that we see on the cover letter that we're usually provided or in the claim referral form as well. So the date of loss here will be December 8th, 2023. Our insured, Jane Doe, John Doe, first day missed. We're going to stick with that December 8th, 2023. The first day missed is relevant because a lot of times the accident will happen at night or after the workday. And therefore, we're going to start our lost earnings calculation on December 9th, if that were to be the case. That's something that everyone who works on the claims will confirm with your office or with the insured just to see what day they actually stopped working. We don't want to give them an extra day of earnings if they had worked that full day of the accident. If you want to go ahead, Abby. So the steps we usually take to complete a no-fault calculation is around 3 different schedules and a written report. So the tax return analysis is typically where we start, and then we'll do the earnings analysis from there, roll it up into a loss summary, and then we will write a written report just confirming everything that we did in our calculations. So for the tax return analysis, this is really important. As Abby mentioned, we like to confirm all of our tax returns with the IRS transcripts. We take our discontinued expenses from the tax return and we like to calculate a 2-year average. So if we're provided ideally 2023 tax returns, 2022 tax returns, and they are around a comparable amount or an expected growth rate, we'd like to just take the 2-year average because as we know, year after year, things change. If they are wildly different, one year they're reporting 0, the next year they're reporting 100,000, then we'll probably only use 1 year. And that's kind of the stuff that we like to figure out in discussions with the insured or the claimant. So in this situation with our 2-year average, we calculate our expenses as a percentage of revenue. This is because as your revenue changes, your expenses change in relation to that revenue. So these costs are fixed versus variable. And when we go through our expenses, that's what we are trying to determine to see what's discontinued. So variable costs are what's going to be discontinued, and fixed costs are what's going to not be taken out. This is because, for example, some people still have to pay certain expenses regardless if they're working or not. So if we're to go through this, we'll see, and Abby, if you want to flip to the next slide. We'll see here that advertising is something that you would have to pay whether or not you are working or not working. Bank charges are something that fluctuate. If you're not making sales, a lot of times you don't have to pay those bank fees, credit card fees. Continuing education, depreciation, leasing, a lot of times those things you are still having to pay regardless whether or not you are working. This is a case-by-case basis. It's something we like to discuss with the insured, and it changes depending on the type of business. General expenses, we typically do take as a discontinued expense. Meals and entertainment, office expense, these things you would not have to incur if you were not working. Especially supplies, let's say you are a cleaning person, you probably, if you're not working and not cleaning homes, then you are not going to have to expend the same amount as you would normally in supplies. And that's why we take this as a percentage of revenue, because it wouldn't be fair to just take a fixed amount. It depends on how much revenue you're making. As Abby mentioned previously, gas is the biggest example of this. We see fuel expense, we see Uber and Lyft fees on Uber drivers. Those are always going to be discontinued because, as she mentioned, if you are not going to be driving your vehicle, you are going to be saving money on gas. This is something that a lot of people have an issue with or struggle to understand, but ultimately we have to factor in these saved costs. The earnings analysis varies depending case by case. As I mentioned before, sometimes you'll be temporarily disabled, or sometimes we'll have an insured or claimant who is completely out of work. We always start with the actual gross earnings. We usually like to start with the Schedule 1120S, the Schedule C, and that's where we pull the amounts directly from the tax return. You can see that in 2022 and 2023, that's what we did. We took the amount from the tax return. However, we also like to confirm these with all of the documents that Abby had mentioned prior, the bank statements, the invoices, the receipts, any of these things that were provided, so that we feel comfortable with when the earnings are generated. The tax return is obviously on an annual basis. A lot of times things can be seasonal, and it's important to understand exactly what month these earnings are generated. So under actual gross earnings, we do have scheduled out January through December 31st of whatever we received. In this case, we'll say we received bank statements. It's also important that from the Schedule C, the $250,000, we would like to see that it matches the bank statements or whatever support we are receiving. If it's slightly off, that can be okay, but if it is massively off, we're going to have a lot of questions about the validity of the tax return. So in this situation, we are going to roll this forward to make our average daily gross earnings our lost gross earnings amount by day. So in this situation, we want to take the amount of earnings that were generated before the loss. So here we're going to take January 1st, 2023, and our loss date was December 8th. So we would want to go through December 7th, because we don't want our projection to include the day that it is loss affected. So if you want to go to the next slide, Abby. I have that populated here, January 1st through December 7th. That gives us our $241,000. And then we divide that by the number of days in that period. That period is 341 days, and that gets our average daily gross earnings of $708.21. This is now something that we take and roll forward into the 30-day periods. We have 30-day periods calculated as that is how you guys make your payments as insurance companies. And so we like to lay that out for you so that it's easy to understand. Here, we'll start on the loss period, December 8th. As I mentioned before, if December 8th was the date of loss and they started the day after, this is where we would reflect a December 9th start date. So our expected gross earnings are going to come from that $708.21 times 30, because we're trying to calculate for a 30-day period. And here we're going to have to deduct their actual gross earnings. And that's because, if you remember, we said they were only partially disabled. So they still were able to work in some capacity, just not at the same capacity as before. Naturally, if they're working somewhat, we have to deduct the actual earnings that they're making, as it wouldn't be fair to just calculate a full projection as if they were completely not working. And that's why it's really important to see bank statements or other earnings so that we can verify that they weren't actually working at that time. So here, December 8th through June 4th, we have deducted those actual gross earnings, and that is going to give us a lost daily gross earnings value of $180.43. Then we like to roll this forward to our loss summary. This makes it very simple for you as clients to understand how much you need to pay out and for what periods. So if you want to go to the next slide, Abby, I have this populated. Okay, so our loss period, as we mentioned, started 12/8. It went through June 4th. Now, June 4th is a date that either we will continuously update if they are continuously disabled, or you will provide us with the date that we can stop their earnings. So if it's not within that 30-day period, that last period, we will calculate with however many days are in that 30-day period that they are actually lost. For example, if they went back to work in full capacity on June 1st, we obviously wouldn't calculate the last period through June 4th. We would only calculate it for the 26 days to June 1st. So here we're pulling that average daily lost gross earnings value, the 180.43 for every period. And then we are going to deduct those discontinued expenses. This is also where we would deduct those cost of goods sold to get to your gross profit, as Abby was discussing before. But a lot of times we do just see the discontinued expenses being deducted, as they don't have any cost of goods sold. So we'll take that 180.43 at 41.39%, and that will get us to our lost daily net earnings. And we're going to want to multiply that by the number of days missed. At times, depending on the actual earnings, we will take period by period separately and say this period has a different value than the other period, just based on how their actual earnings look. Here, when you multiply it by 30, we're going to get the 3,172.79 per period. And that gets us our final answer of number of days missed, 180, and lost net earnings per period of 19,036. The report is something we issue on every single file. After we do our analysis, we go immediately to the report. As Abby mentioned before, with those 30-day request letters, if we have an insured or a claimant who has not provided us any of the information that we have requested within 90 days, we are going to issue a closing file report. So regardless of if we have information or not, you will always get a report. The closing file report is going to show this is what we requested on X day. We sent follow-up requests this date, and this date, and have still not received a response. Therefore, we are not going to go forward with any lost net earnings calculation, and this report can prove that we have closed out this file. In this situation, when we do write a report, we have our first couple of paragraphs. They are very standard, just kind of understanding what we have done. We've taken certain records and other pertinent data. This is how we formed our opinions. And then if you go to the next slide, we get specific to the loss. So here we're always going to write the date that we received all requested documents. This way you can understand how long it has taken on our end. We really like to get these reports out speedy. We try and have them done within a week. Sometimes occasionally it goes 2 weeks, but usually we like to have them done in a week. And as of July 3rd, the insured provided our firm with all requested documents. That lets you know how long it has taken us to issue a report from when we received everything from the insured or the claimant. Also here, we like to note when we have confirmed with your office the first day missed. Here we'll say per correspondence dated March 5th. That can either be on the cover letter, or it's something that we like to just call and confirm with you. Additionally, like to confirm with the insured and the claimant as well. Then we have our paragraph going on about the actual earnings. Based on the documents we were provided to date, the lost net earnings are 105.76 per day, and the 3,172.79 for that 180-day period. We try and be very clear about the amount of periods that we're paying out for, the actual date, and the value of that. And we also refer to Schedule 1 for the breakdown of 30-day loss period. Since they continue to operate at a limited capacity, and this happens in a lot of reports where we have our actual earnings because they are working at a part-time capacity, we can only update the report as far as time goes. So, we need to wait a lot of times to get those actual earnings to issue the report. And that's why we will issue updated reports frequently. So as we mentioned here, since the insured continues to operate their business at a limited capacity, we'll update our analysis subsequent to June 4th, 2024. And if you remember on our loss summary, the June 4th was the last date that we had reflected. So as we continue to get information in, we'll continue to update our reports. The updated reports are usually significantly quicker than the process that it takes for a regular report. We've had updated reports go on for months and months, even years sometimes. And that's something that we can kind of streamline the process of, is working with your insured or claimant, having them know exactly what they have to provide to us, and just keep getting these 30-day calculations out for you to make it easier for you. This is the last part of our report where we just like to describe the 3 or 4 schedules. Typically there's 3 schedules. If there's 4, it is because we've usually done a substitute service analysis, which Abby was discussing before. And sometimes if they have no loss, we'll only issue 2 schedules, but typically it's only around 2 to 4 schedules. Summary of information considered, we're just going to list out everything that we received for this claim particularly. We're pretty much always going to have tax returns. A lot of times we like to see bank statements, monthly earnings, and the NF2, the NF7 that we have described before, and of course, written and verbal communication with the insured or the claimant, as well as your office. This brings us to the online referral form. These things that we discussed in the case, date of loss, insured claimant, these are all things that you can do easily on our website. And I believe if Abby hasn't already, she's going to drop that link into the chat. This just helps it for you guys. It's very easily laid out. If Abby goes to the next slide, I think it shows you exactly what that form looks like. Yes, you hit refer a claim. And then it'll prompt you to go through all of these things: claim type, name and or business of the insured or claimant, referral number. And this is just an easy way for us to get claims, and it's an easy way for you to provide information to us, and we can get that going right away. Once you hit submit on that, it comes into our queue, and we will immediately reach out to the insured or the claimant, or you, whoever is working on the file, and get that wrapped up. So I think that's just an easy process that we have newly implemented that is important for you all to know about. Yes, and thank you, Abby. You've just dropped that in the chat. That way we can just streamline this process even easier than we have it as is. Now that kind of wraps up our presentation. You are always available to contact us. Abby handles a lot of the communications between the insurance companies, the claimants, and the insureds. I also am always happy to take a call. And if you go to the next slide, we provide our contact information.
Questions?
Yes, we have questions with our
information.
contact information. We have about 10 minutes left, so we kind of left perfect timing for the amount of questions. You can drop them in the chat, as I know that you are all muted.
Yeah, we have a couple questions in the Q&A chat, so I can read off a couple of those. So our first question says, for someone who just started their business, then goes out of work, their first year has a lot of startup costs for equipment, work truck, etc. The profits are more than expenses due to being a new business. Is there any documentation they can supply to receive an LOI payment? Yeah, so I think I've definitely seen this happen a couple of times where somebody will have started their business in the prior year and their costs are way more than the actual income that they've received. I think in this case, we would just want to see some type of documentation to support what these expenses were and when they were paid, if it was prior to the generation of earnings or if it was after they had already been in business for a while. That's definitely something we would kind of take on a case-by-case basis, depending on what the expenses are, if they've amortized any of the expenses, and how much the business was actually generating. I think if, let's say somebody's business generated $1,000 in the prior year, but their expenses were $50,000. But then in the first 6 months of the new year, they generated consistent earnings and the expenses went back to normal. I probably wouldn't take into consideration much from the prior year, considering the business had just started. So I think it would just kind of depend on the situation, and we take a look at everything and obviously take into consideration that they just started the business. So maybe the prior year tax return isn't going to reflect an accurate business, I guess, model. I don't know.
Right. And a lot of times, to piggyback on what Abby said too, we can take an industry average. Sometimes when their expenses are unclear, they don't seem accurate, or they're inflated due to being the first year in business. We do so many of these claims that we do have good data on what a typical expense ratio should be. So we can take industry analysis. Also, we can have someone provide, a lot of times I ask insured or claimants to provide me with a listing of all the expenses they had that they believe were startup, and I'll use that at my own discretion. But I think the big thing is that we do have a lot of data on these claims and we know what's normal. So we can just default to take an industry average.
Right. Yeah, that's a good one to put it. Typically, that average is around 50%, give or take. I think 50% is probably the most common that I've seen, but I actually do plan on doing some further research on the different industries that we see to see what exactly the estimate of discontinued expenses should be. So, good question.
Thank you.
The next question on here says, would weekend days be included if they work a Monday through Friday schedule? So this is something relatively new that we've kind of brought into discussion. In prior years, we've always considered somebody who is self-employed to have a 7-day work week, just because if they are self-employed, it's our opinion that they could work 7 days a week, but more recently, we've come to discover that certain industries just don't work like that. For example, I had a claim where somebody was in social work and she really only works Monday through Friday. So I had to kind of amend my calculations a little bit to go through each 30-day loss period and find however many Monday through Fridays there were for the period. I think in the end, it kind of averages out to be the same if I was to allocate the earnings amongst a 5-day work week or a 7-day work week. They're either going to get paid a certain amount for 25 out of 30 days, let's say, or they're going to get a lower amount for 30 out of 30 days. So that's definitely something that we're in the works of discussing. And, if you want us to calculate the loss on a different schedule rather than a 7-day workday schedule, we can definitely take a look at that, take a look at the historical earnings and figure it out from there. But it's definitely something that we have been discussing a lot recently. So,
Yes, we have seen that a lot. And with that lost earnings calculation that I showed you, when we're determining the projection and the pre-loss earnings, the number of days that we're dividing by, instead of being considering 7 days a week from, say, January 1st to June 4th, we're only going to consider the amount of days, amount of 5-day work weeks within that same period. So we're going to be dividing by a smaller number of days, which will make the daily value higher. And as Abby said, that's something that we've been doing kind of a lot lately. It seems to be a newer thing, but we are completely capable of doing a 5-6 day work week.
definitely. Another one. Can you explain in further details what is considered as passive income, as we hear this a lot? I don't know if Sophia, if you want to start with this.
Yeah, passive income. Are you referring to like a rent example? If they were to own a property and they just have passive income on this, so let's say it's something like that. If their disability or whatever happened to them or whatever happened to their business is it doesn't affect their passive income. So let's take that same example where I get passive income from a house or a business or something that I do, vending machines. If I'm disabled, those are still operating. So there's no loss there. We'll analyze this on a case by case basis, but a lot of times our opinion is that you haven't suffered a loss, and we have no problem looking at that, writing that, saying that, to back that up. If they, let's say, couldn't collect their money, or they, we would see that. And a lot of times when they argue, oh, this is passive income, we can see that they had X amount of earnings prior to the loss and X amount of earnings after the loss. So we're not just going to accept that as an answer without proof. So yeah, like I said, it's a bit of a case by case basis, but in my opinion, if it's passive income that they don't actually have to do anything or be involved in, then they haven't suffered a loss.
Yeah, I definitely agree. I think the only thing that I've really seen that could possibly be considered a loss in regards to passive income is somebody who's a landlord and has multiple properties. They may be the maintenance worker for those properties themselves. And I've seen a few claims in the past where they had to hire somebody to do that maintenance for them, in which we could consider that portion of the claim as substitute services. But if it's something like collecting rent, you don't really need to do much for that. I mean, I guess you could say you had to physically go there, but if you're able to get somebody to do that for you, there's not really a loss there. So that's a good question. If there's any other questions, we have a couple more minutes here. We could go over them.
Okay. If there's no more questions, we do really appreciate your time in sitting with us. Like we said, we do deal with so many of these claims, and we are happy to talk to you about any specific circumstance outside of this webinar. Anything you might want to contact us about, Abby has put our contact information there. And yeah, we just look forward to keep getting claims in and hopefully working with a lot of you guys that are on this webinar.
Yeah, thank you everybody for joining. We really appreciate it. And, we look forward to working with you. If we don't work with you much now, hopefully we can work with you in the future.
Yes.
So, yeah. All right, guys, thank you.
Thank you.